Good afternoon, everyone, and welcome to this afternoon's Treasury Lab. My name's Guy Barker, and I work for HSBC as part of their global liquidity and cash management business. This afternoon, we're going to be discussing cultural and policy considerations in a post-COVID Treasury. We'll be discussing how Treasury has enabled a corporate Treasury team to review its policies and play a meaningful role in delivering, amongst other things, enhanced colleague and customer experience, focused tangible progress against the group's sustainability objectives, better funding and investment decisions, and we will also be discussing the cultural changes we have seen and maybe what changes still need to be made across the industry. From a housekeeping perspective, you will see that there's a word cloud that you have the ability to join. Please feel free to add as many words to that as you would like. From an audience Q&A perspective, you should be able to see a toolbar on the right-hand side of your screen that will be available throughout this session. This session is, of course, being recorded. It will be made available to be replayed and on the event platform. Also, please get engaged with the ACT on social media. Join ACT's active LinkedIn groups. Follow us on Twitter at ACT Update and tweet using hashtag ACTAC21. Okay, so whilst the polling is continuing, you'll see that I'm joined by two colleagues. So Arnav and Martin, could I ask you to introduce yourselves, please?
Thank you, Guy. My name is Arnav Das. I'm responsible for proposition management and commercialization of business investments that we make in cash management for UK market for commercial banking customers. Thank you.
Hi, I'm Martin McNamara, and I'm a liquidity investment specialist at HSBC Global Asset Management, and I've been involved in the development of our new ESG money market funds, which we're going to reference over the course of today's session.
Brilliant. Okay, thank you both, and welcome everyone who's joined. Andrew, could we stop the word cloud, please? So hopefully, lots of those words which showed up are reassuring because they play to lots of the content that we're talking about. Arnav, if I may, technology being the key driver that we have seen and a catalyst through COVID, what impact do you think that it has had on legacy cultures, opinions, and technology user cases in a corporate treasury?
Sure. Thank you, Guy. I think the biggest cultural shift pre and post COVID that we have seen is a changing culture from just in time to just in case. If I reflect back on the word cloud as well, there are a couple of words that stood out, the agility and the fluidity point from treasury perspective. So three pillars that we have been tracking in terms of the differences. The first one is the supply chain management, the disruptions that has been caused due to pandemic, globally, regionally. The culture has definitely shifted from managing those supply chains just in time to just in case. So building and reconfiguring alternative supply chains. The second impact has been maybe a shift towards looking and managing liquidity in a more short-term basis. So previously, cash flow forecasting in treasury operations had a mid to long-term view. Under the pandemic, there were two essential requirements from treasury point of view. First of all, finding and managing the source of funding, looking inside as well as external in the market, but as well as building that short to mid-term view to manage the day-to-day operations. The third pillar has been definitely the banking relationships. So again, looking at the just-in-case type of configuration of banking relationship, what is the easiest way to move between banking relationships and how COVID-19 or digitization has enabled that to happen through e-signatures, through digital documents, without the need to be physically present to open accounts or relationships. So I think to summarize, the mandate for corporate treasury has more or less remained the same. Including the counterparty, liquidity, financial, working capital management risk. But the ways for solving for it has been different. And there is also a convergence of technological solutions. COVID-19 has increased adoption of some of the solutions, both from banking relationship perspective as well as from business reconfigurement perspective.
Thanks, Arnav. And Martin, your view?
Yeah, I would certainly echo Arnav's, particularly his point around the focus on short-term cash and actually how technology has played a bigger role in enabling corporate treasurers to consider their short-term investing strategies put them under greater scrutiny. So there's been a great deal of additional efficiencies which have been derived from technology, and that adoption, as Aaron has said, has been accelerated throughout the course of the COVID-19 pandemic, and it's allowing actually a broader group of corporate treasurers to work smarter. It's not necessarily just the largest, most well-resourced corporate treasury functions. It's now proliferating down throughout corporate treasury more broadly. And that ability to better handle a global cash book through the adoption of cash pooling, for example, again is driving greater efficiencies. Another trend that we're seeing is there's much less trapped cash in various different global locations. So UK corporates in particular, the trend we've seen is that they've been pooling that cash, bringing that cash back to the UK over the course of 2020. And what that's done is that's combined with better cash flow forecasting, it's allowed corporate treasurers to do that better cash segmentation, as Aaron have referenced. So we're seeing the adoption of automated cash sweeps, and HSBC. We work closely with yourselves in global cash management on your liquidity investment solutions platform, which again automates, makes things efficient. It allows access to our money market funds on an automated basis. And I understand there's been some recent enhancements which allow users to actively trade against the money market funds that we offer. And again, that allows corporate treasurers to leverage the further enhancements around real-time information they have more directly.
Thank you. You've talked about the importance of technology there, Martin, which in many cases are reliant on the relationship between banks and fintechs, and open banking has accelerated the functionality and the availability of that functionality. Where do we expect that to go in the short and longer term?
Well, I certainly think we can see, we'll expect to see a continuation on both the development of open banking and on fintech side. About 2 years ago, I wrote an article for the ACT's Treasurer's Guide to Corporate Treasury, and that was on the integration of tech in treasury and liquidity management, essentially the digitization of banking. Now, that was 2 years ago, Guy. It feels like a lifetime ago in the context of COVID. And what we see in terms of the acceleration is Nissan Micra to Porsche 911. It's just exponentially different. And the innovations kept pace with that, with further digitization. What I summarized in the final and closing comments of that article was that the successful banks will be those that embrace fintech, and the fintechs will be successful will be those that embrace banking, and that's at odds with a lot of people's thinking around them, as you've got David versus Goliath. Actually, no one wins in that scenario, but if they work together, we can create those institutions that do work together will ultimately, I think, be more successful. Open banking creates a lot more opportunities for efficiencies, and they're welcomed by both treasurers and financial institutions alike. And the more efficiencies in treasurers, the more able treasurers are able to deploy or enable the business to deploy resources either directly into the business or to potentially reduce financing costs and just invest smarter.
Great, thanks, Martin. And Aaron, I guess that your views are similar?
Yes, absolutely. So I think what open banking has done so far is kind of driven a horizontal efficiency for business or corporate treasury. So what I mean by that is pre-open banking, it was about individually maybe managing and looking at banking relationships and trying to maybe gain efficiencies within that. But with open banking, there is now consolidation. So it's possible to look at different accounts or flows or balances in real time across different banks without waiting for end of day statement or an intraday statement. So it can all happen in near real time or real time. So I think that consolidation has also driven, to Martin's point earlier, some of the trapped cash, visibility to some of the trapped cash. If you look at the word cloud and reflect back on it, visibility was definitely one of the words that appeared. I think open banking kind of helps in raising the visibility across relationships. In terms of where it is going, I think there has to be a convergence between the on-demand economy that we have seen post-COVID. So things getting more maybe e-commerce or m-commerce, less physical stores or cash and checks kind of instruments, integrated with on-demand treasury. So open banking can definitely facilitate that enablement of business requirements around on-demand economy, the payments, the collections with respect to treasury strategies. And that can be done across channels. So mobile channel or e-commerce channel. So it's an omni-channel kind of proposition that can be done across instruments, providing customers of customers the optionality to maybe lean on some of those different instruments that they may not have seen or had the option for. From the visibility perspective, if there is enhanced visibility, then to go back to the previous point, it improves the ability to manage cash as well in the short to mid-term and move away from that long-term view based on a need of the situation.
Efficiency and automation have always been the buzzwords for highly capable treasury teams. And in the present, is there an opportunity to contribute towards the development of a group's culture further and their sustainability objectives? And these, I guess, should not be taken lightly. Martin, if I could come to you first, is this a trend? Is this a trend that you're seeing from your customers and also in the products and services that we're being asked to develop?
Yeah, I mean, absolutely. Although I think it's moved from trend to major cultural shift, and I think, and I'll explain why I think it's a major cultural shift versus just a trend that we've seen over recent years. The drivers, as I see them, are sort of fourfold. Firstly, there's a major societal shift, and I mean that even at a personal level. This, sustainability is something that we are individually engaged with, and we all have a role to play in it. So that belief alone, if that's replicated many millions of times, represents itself as a societal shift. I recently moderated a panel on which Joanna Bonnet, Group Treasurer and Head of Sustainability at Page Group, I'm just not going to mind me reference her in this way, she talked about corporates in the UK and more widely operating with a social license. Now, that really resonated with me for the comments I just made around how personal this is to individuals. A license is earned in this context, if a firm is not proactive in maintaining that license, they risk losing it. And what does that mean? That means customers and clients walk away, and investors potentially over time turn their back on those corporates. So from a societal perspective, corporates are very alive to the risks of the way that they're being perceived and how their business models need to adapt to improve the sustainability of their businesses. Another factor is that regulation is increasingly driving transparency. There are now 64 jurisdictions around the world where disclosure requirements are in place. 65% of those are actually mandatory, and that's really putting a spotlight on corporate activities, which again allows people to build those pictures of what's going on within those businesses. And then government's net zero ambitions linked to the Sustainable Development Goals, which is often a key policy driver, are being reflected in government policy, which then translates into government incentives potentially. And then the final factor is that and this is kind of, I guess, linked to the transparency around sustainability. ESG risks will ultimately inevitably be priced into refinancing of corporates, and what we expect to see over a longer term, this isn't going to happen in the short term, but we expect to see is going to be a widening of yield or spread differential between the better performing firms from an ESG perspective versus those worst performing. So this is a live issue. And what we're seeing is corporate sustainability programs becoming more commonplace, and that, a bit like a waterfall, is trickling down into all areas of the business that they support, from supply chain management that Aaron have referenced earlier on, down, of course, of course, down to treasury management as well. And as a consequence of that, we're seeing the emergence of what are referred to as sustainable finance frameworks. And this shift, this focus, this transition of focus is within treasury is creating that cultural change that we're referencing.
And Aranev, what's your view?
I think I will pick up the point about ESG risk that Martin mentioned. And if we start to decouple them, there is also an interplay between the E, S, and G angles of it. So starting with the environmental angle, and this has been a theme of treasury in the past as well, the digitization journey. So that definitely helps in the E part of the environmental part. So less paper and end-to-end processing, be it payments, be it reconciliation, but also onboarding of relationships. So using e-signatures or digital documents, it reduces the ecological footprint. And one may even think about cash flow forecasting. So in the past, maybe it was based on 20 plus Excel files. And now there are tools with predictive capability of doing that in much shorter time, using much less resource. So that could also play in the efficiency point of environmental agenda. Then moving on to the societal point that Martin mentioned as well. So supply chain dynamics and sustainability from transaction banking perspective and from treasury perspective, it could mean looking at financing solutions specifically for smaller businesses. And if we then think about the workforce angle for societal pillar of ESG, then everything that is done in the digitization space, in the automation space, should help the workforce to reduce the working hours, to have a better work-life balance, and maybe even redeploy some of the workforce in less energy-intense kind of activities which is required by the business. And then finally moving on to the governance pillar, and Martin mentioned to it from risk perspective, that the refinancing cost or financing cost of raising capital in the markets could increase if the ESG rating is not where it needs to be for a business. Then treasury definitely has a big role to play in it. And those roles could be along, again, three different themes. One of them could be how the finances are raised. So thinking about green loans or green bonds, and whatever is the financing strategy, how is it aligned to the corporate strategy for deployment in a sustainable initiatives or developments. The second fact, which is, or the theme which is less often mentioned, is cybersecurity as well from governance point of view, and any kind of disruption that might be caused because of lack of robust controls around cybersecurity. The third one is investment, and this is what Martin was mentioning as well. So treasury policies around money market funds or green deposits could also be seen as one of the ways of maybe driving the corporate agenda around ESG strategy. And all of them in combination, treasury could definitely be helping in that rating of the business and more ESG compliant.
Right, thank you, Aranev. And Aranev, as a follow-up question, do you think we'll ever get to a space where we'll be able to measure treasury-related emissions and help our customers maintain all of those great working practices, energy savings that we've seen through COVID to date?
I think we are just about at the beginning of that journey, and there are different measures that could be used. So one measure could be the physical instruments. So if cash or checks is used, there are industry metrics which track the energy consumption for a check processing or cash moving in the economy. So that could be one measure of looking at the cost of processing paper. The second measure could be consumption of electricity. So if there are operational inefficiencies within treasury, then a direct benchmark would be what is the energy consumption today versus post those efficiencies and digitization. So I would like to think we are at the beginning of that journey, and treasury operations specifically. I mean, it's a broader theme than treasury operations, but staying within treasury operations, it's about maybe finding out those friction points, looking at the cash conversion cycle, looking at the financing, risk mitigation processes, maybe the investment cycle, and just to figure out what are the friction points and do a pre and post kind of measurement to see how the agenda for digitization, for real-time treasury, for on-demand treasury could be converging towards ESG strategy.
Great, thank you, Aranev. Martin, you mentioned sustainable finance frameworks. What exactly are these, and how can these be of benefit to Treasury operations?
Yeah, so broadly speaking, sustainable frameworks are essentially designed to support an organization by offering an avenue for investment, as well as strengthening the business's resilience to ESG factors as they relate to corporate treasury. So first of all, they should reflect the business sustainability priorities. So they should be consistent with those set at a corporate level. And the role they have is one of the key roles they have is in order to obtain senior support and engagement on these issues within corporate treasury. You've got to get that support. You've got to set expectations with senior management, and then of course they become reportable on. So there's a measure of performance against them, and these frameworks. The reason why these frameworks are so important is because they're built on and evolved over time. And an analogy of that would be the Couch to 5K. So over the COVID-19 pandemic, I understand that the Couch to 5K app was one of the most downloaded apps as people set themselves goals and they work to attain that goal. Now, you could apply the same logic to a sustainable framework. You set down a set of goals, and those goals initially are relatively easy to meet, and most people would achieve Couch to 5K. The challenge, and this is where the evolution and the opportunity to build on something comes, is getting your 5K time from what is called, so 45 minutes down to 44 minutes, and that's where the real test comes, and that's where the real challenge is. And the same thing that the introduction of these these sustainable finance frameworks can do is it sets the baseline on which to improve and develop on. Now, these corporate sustainability frameworks, corporate finance sustainable finance frameworks, also align to the corporate sustainability objectives directly, or even potentially support them, potentially via the issuance of green bonds to support a specific project, for example. Now, that's often where we've seen a lot of the focus in sustainability in treasury management. It's been on that. It's been historically on that funding side, but increasingly we're starting to see it now move over onto the investment side, and the products that are coming to the market to support that by way of green deposits, although they have their constraints, and of course much more recently ESG money market funds.
Thanks, Martin. Green deposits is an interesting point. I was talking to a corporate treasurer yesterday who said that they have considerable funds on balance sheet and they can't find a home for a green deposit. I guess lots of people on this call may have similar challenges and issues. Could we explore why that availability for a home for these deposits just doesn't seem to be available at the moment? Aaron, I don't know if that's a question you'd like to take.
Sorry, I just had a disruption. Do you mind going again?
Yeah, of course. Yeah, Martin mentioned the green deposits, and I was talking to a treasurer yesterday who said they have significant monies on balance sheet. They're up to their treasury policy with certain providers, and other providers of green deposits are full up, i.e. there is no more room to invest in their specific green deposit. I guess that there's lots of people on this call who may have similar challenges. Could you talk about the green deposits and that particular dynamic, please?
I think what we have been seeing is that there is a demand versus supply gap. So there's a supply of deposits, green deposits, but in terms of the demand, which is kind of a correlation with the deployment of those deposits. So it needs to be for initiatives or investments which are for green or ESG kind of agenda. So unless there is more demand for investing into either infrastructure or building supply chains or distribution channels, or even business growth, which leans on primarily the pillars of ESG, there will always be a bottleneck, because we are, I think, oversubscribed on the supply side, and undersubscribed on the demand side. Which is what is causing the current bottleneck. So the way to get past it, I would like to think, is for our businesses to be thinking more about investing into sustainable initiatives. We should also look at maybe the capital markets and the success of green bonds in that space, because those financing solutions are used specifically for sustainability or ESG agenda. So something like that similarly needs to play out maybe in the small, medium enterprise space as well, so that there is enough opportunities to deploy the excess supply that we have got in the green deposit space.
Okay, thank you, Arnav. And another question which comes through, which I'd like to point towards you, Martin, if that's okay, is ESG is becoming considerably important. How do we know what is really green or sustainable? So perhaps
it's a good question, and probably quite a long answer, but because the challenge is real, the challenge is very real for investors, because there is actually no single definition of what constitutes sustainable, or in the context of money market funds, sustainably invested, and that means there's a real problem for investors in determining what is indeed sustainable. There has been some recent developments from a regulatory perspective. So the EU sustainable disclosure, the EU sustainable finance disclosure regulation, which was brought in March of this year, did try and seek to create some kind of common framework for how sustainable factors were considered, or rather how they were reported on, based on the objectives of the fund. Unfortunately, it's not really, I don't think it's going to achieve the objective it set out to do so. I think that because there's too much of a difference between the various different between what different managers consider to be sustainably invested, there will be, that presents a real, the dilemma is still there. So it's therefore going to be entirely incumbent on investors not to rely on the classifications that funds are recorded under the SFDR regulation. They're going to have to lift the lid on those investment strategies. They're going to have to understand how credible the applications of sustainable investment principles really are. So I think there's I don't think regulation is going to save the day for investors here. I think they're going to have to do a lot of work to understand, how that fund is applying its sustainable investment principles. And as I say, there is no one definition of what constitutes sustainable.
Okay, thank you, Martin. Arnav, I'll come to you with the next one, if I may. COVID has instilled, it feels, an increased culture of readiness for treasuries and financial service providers alike. Are there any more products or developments that will be of benefit and will take this trend further? So what exciting new functionality will become available to corporate treasurers that will continue that confidence of readiness?
I think based on the surveys that I have seen recently, corporate treasury is actually seen as ready and prepared, and they have come out very well, the vast majority of them, because of the readiness post 2008 financial crisis, and also the preparedness for contingency for Brexit. But to answer your question, I think the most exciting thing from my perspective is the focus on the sales collections piece and the forecasting piece. So I guess traditionally, the focus has been on automating everything which was push payments, so paying to the suppliers, and maybe less so on the receivable side. And I'm saying that because maybe there was not an active analysis of what are the different ways the money was reaching the corporate in terms of inflows, where there's cash instruments or check instruments. So something which is happening in the real-time space for corporate treasury is collection on a real-time basis as well. So some of the card acquiring capabilities are now providing next day settlements, for example, which is a big leap from T+3 or T+2 kind of thing. And even more exciting space is the concept of near real-time cross-border payments. And that's something which is seen in the light of paying as a local or receiving as a local. So the whole international experience of making payments or receiving payments becomes a domestic experience. So there is no need to wait for 3 to 5 days to make a payment or receive a payment by the traditional networks. There's an opportunity now to pay those or receive those almost near real time. It depends on the time zone differences. With that considered, the payments can be held up until the last minute instead of making it 3 or 5 days earlier. Equally, the receipts, the cash inflows can become almost in real time. So those are the exciting products or opportunities that I see. I mentioned about cash flow forecasting. I think that is a pretty exciting space as well, because Excel spreadsheets, which is what vast majority of businesses used in the past for forecasting the flows, do not essentially provide historic trend or pattern analysis. They are all visuals. Maybe macros can be built, etc. But they do not provide the opportunity to bring in additional insights. What's happening in the industry? What is the peer-to-peer comparison? What are the DPOs or the DSOs looking like? I guess the next stage is, how does cash flow forecasting and machine learning and data science bring all of that together for corporate treasury, so that they are able to find out the drivers and the building blocks of cash inflows and outflows, but feed that back to the business, both from customer point of view as well as from supplier's perspective.
I think this next question kind of builds on a point that was made earlier, but it follows on quite nicely from what you've just said, Aranav, is that will we eventually see each service provided by a bank or fintech come with an ESG requirement or rating?
I think definitely yes. The way we are looking at it, it's an end-to-end journey. So it starts with the onboarding journey. And how do we remove paper or documents from that completely? Then it moves on to the interaction with the bank. So previously, maybe a lot of interfaces were based on hard token if it was logging into the banking website. Now they are done via soft token. For example, now there is also connectivity through APIs. So there is no need for tokens in some cases, soft or hard. So, and that also brings the real timeliness to it. So that's the second part of the journey, from onboarding to enablement to accessing banking. And then we move on to the solutions or the proposition from ESG angle. And definitely, yes, again, from end-to-end lifecycle perspective, initiating a transaction, looking at the status of the transaction, which maybe previously was end of the day through a statement from balances perspective. So all of that is moving in the digital space. So now it is easy to track and trace payments, just like we can track DHL parcels. And then finally moving on to the reconciliation piece of statement and reporting. Again, previously, majority of it was either paper statement or maybe even end of day electronic statements, which still needed to be reconciled because of partial matches. But now with the concept of APIs, it could become real time, and any issues can be identified on the spot rather than waiting till next day. So I guess this end-to-end life cycle of the customer journey as well as the transaction journey definitely is moving in the space where it would be seen as more or less energy intensive and more ESG certified.
Martin, I saw you nodding there at the start. Did you have anything to add?
No. I think Aranav covers that beautifully.
Okay, I'll let you have the mic still. Last year there was such a focus on managing the unknown. Any thoughts on how one can start to be more strategic with managing treasury cash?
Yeah, well, I mean, I think to Aranav's point earlier on, clients are beginning to look much more intensely at their short-term cash, and for some of the and so that's going to continue to be a major focus. But given in particular where rates are at the moment, but also given where the technological advancements and innovation that have been adopted, there is much more scope to look more strategically at cash, because you're able to segment your cash more effectively. So I think that with rates where they are, we'll continue to see a search for yield. But equally, in an environment where there is very little yield, there's very little reward for taking additional credit exposure, I think we'll, linked to the sustainability point, I think we'll see a lot more firms that are actually switching focus within Treasury away from search for yield and actually a search for sustainability. So there'll be a balancing act, of course, and the priorities of Treasury will remain capital preservation and liquidity. But it'll just be interesting to see whether there is a price that corporates are willing to pay to support more sustainable objectives within Treasury management.
Guy, what are your thoughts? What have you been hearing in this space? based on your interactions with customers?
Yes, well, undoubtedly, we need a ticket to the game. So clients are always asking us what HSBC's credentials are from a service provider perspective, which has certainly become far more prevalent in recent months. I think going forward, it's more the expectations. So before it was whether clients could secure treasury spend and tech spend. Now it's definitely yes, we will secure the tech spend, and it's more the when rather than if, and it's the assumption that it will it will fit in and integrate well with the existing treasury processes. I think it's incumbent on banks and trusted advisors, third parties, to demonstrate to them what the savings can be from an efficiency perspective, from an energy perspective, so that we can help our customers tell their story from an efficiency and particularly from an environmental perspective, because we've made so many good gains in the last 18 months. It would be a real shame if we didn't make the most of them. Aaron, to finish with you, if I may, and Martin, please feel free to chip in. Last question: we're having so many more black swan events. How are banks and other financial service providers making sure that products remain useful? And are we reducing the product life cycle? So I guess what's the evolution of our customer offering?
I think it's a fantastic question. Really like the way it has been posed. My reflections are the black swan events actually do not essentially change the what part of the business. It's the how that gets changed. So if we reflect back on the 2008 to 2009 financial crisis, which was one of the black swan events, the crisis was a liquidity crisis. So the how changed, not the what, for the businesses or for treasury. And then if you look or reflect back on COVID-19, another black swan event, then again, the what did not change, but the how, go back to the supply chain disruptions, was how do we manage supply chains in a different way? What is the just in case kind of options? And then how do we provide, or businesses provide options to their customers? If there is no option to pay by cash and check, how do we move in the electronic payment space? And these options have always been available. The only thing that has changed is the adoption of it and the convergence of it. So alongside cash and checks, faster payments had existed in UK for a long time. But it is interesting to see the volume and the values in faster payments have gone up when the checks and the cash volume went down in lockdown. So I would like to think that the black swan events are changing the how part, and bank offerings are there. It's just the adoption of them. Also, a reflection is about the remote working. So a major disruption was the workforce. And from bank and cash management perspective, the question was about how do you log in remotely to manage the treasury. If treasury operations was relying on paper statements that were coming to the office address, how do you manage those kind of implications from blank source? And once again, there are ways of managing it. Moving from physical account to virtual account is a way of managing that as well. It provides a default consolidation. So there is no need for statements, paper or electronic, to manage the consolidation. There's a natural way of doing that. So the point is, I guess, the options are already available. It's the adoption of it and the speed of adoption of it.
Thank you. And, Martin, I'll give you 30 seconds before.
Yeah, I realise we're running up against the end of the session. Look, exactly what Aaron have just said, but to add that financial services is actually an incredibly innovative space. And what we tend to find is that the financial institutions will innovate, and then the clients will follow, and they'll pick up the best practices along the way. So we'll continue to see evolution. We'll continue to see innovation to support corporate treasury, and we'll also see the evolution of existing products so they continue to meet the requirements of the customer bases that they serve. So yeah, innovation and evolution within financial services is what we do, and these black swan events are actually the accelerators in those processes in terms of adoption, as Aaron have said.
Brilliant. Okay. that's a great way to close the session, Martin. Clearly, we all need to be agile as we move forward, because ESG and tech is not going to slow down anytime soon. So on behalf of the ACT and HSBC, thank you very much for listening, and please enjoy the rest of the conference.
Thanks, Guy.
Thank you.